Why did FTX collapse? The real financial story. When FTX collapsed in November 2022, I had crypto. Not on FTX, I was keeping it in a wallet, but I remember exactly where I was when I saw the news. My first reaction was honestly just, I knew it. Not about FTX specifically. I didn't know anything about FTX specifically, but that gut feeling you get when something that seemed too good collapses, and it turns out the people running it were doing exactly what everyone was afraid people were doing. What shook me wasn't the price drop. It was the question it put in my head. If this happened at FTX, what's stopping it from happening somewhere else? What am I actually trusting when I trust a crypto platform with my money? So I went and figured out exactly how the fraud worked, not the drama, the actual financial mechanism, because that's the part that matters. And here's the thing. Once you understand how FTX worked, it actually made me more confident in Bitcoin specifically, not more confident in crypto in general, more confident in the part of this that nobody controls. Let me show you what I mean. You might be thinking, I didn't use FTX. This doesn't affect me. Here's why it does. FTX wasn't some obscure corner of the internet. It was the third largest crypto exchange in the world. It had offices in Miami. Its founder was testifying before the US Senate. It sponsored the Miami Heat Arena. And if you owned any crypto in late 2022 on any platform, FTX's collapse hit the price of everything. Bitcoin dropped 40% in a month, but more than the price, FTX matters because of what it revealed about how these platforms actually work, what they do with your money when you deposit it, what owning crypto on an exchange actually means, because the answer is less than you probably think. This video is the real financial story, no drama for drama's sake. Just here's the machine, here's how it broke, and here's what you should know going forward. Let's start from the very beginning. A crypto exchange is basically a brokerage. You deposit money, you use it to buy crypto, and the exchange holds it for you. When you want to sell, they sell it and give you cash back. Simple enough. The key word there is holds. When you deposit money or crypto onto an exchange, you're trusting that exchange to actually hold it, to keep it safe, to give it back when you ask. This is called custody. The exchange is the custodian of your assets. Now here's the thing, in traditional finance, there are strict rules about what custodians can do with your money. A bank can't just lend your deposits to its founder's hedge fund. An investment firm can't mix client money with its own operating expenses. These rules exist because, historically, when they weren't followed, things went badly, very badly. Crypto in 2022 didn't have those rules, not in any meaningful way. That's the context for everything that follows. Sam Bankman-Fried, known as SBF, founded FTX in 2019. He was, on paper, an extraordinary figure. MIT educated, former quantitative trader at Jane Street, one of the most respected trading firms on Wall Street. He wore a t-shirt and shorts to Senate hearings. He lived in a penthouse in the Bahamas with a group of colleagues who were also his friends, and, in some cases, his romantic partners. He publicly committed to effective altruism, the idea that he was accumulating money specifically to give it away to important causes. He became the second largest donor to the Democratic Party in the 2022 midterms. He was, in short, exactly the kind of person that the financial and political establishment wanted crypto to produce. Credible, smart, apparently responsible, which made the collapse all the more devastating. To understand how FTX collapsed, you need to understand that it wasn't one company. It was two. Company 1, FTX, the exchange, where customers deposited billions of dollars to buy and sell crypto. Company 2, Alameda Research, a trading firm, also founded by SBF, that made bets in the crypto markets. On paper, these were separate businesses. In practice, they were deeply, illegally entangled. Here's the mechanism. When customers deposited money on FTX, that money was supposed to sit in FTX's accounts, available for customers to withdraw whenever they wanted. That's the basic promise of a custodian. Instead, FTX loaned billions of dollars of customer funds to Alameda Research. Alameda used those funds to make high-risk bets in crypto markets. It also used the money to buy illiquid assets, things that are easy to buy but very hard to sell quickly, like startup investments and obscure tokens. So when FTX customers tried to withdraw their money that they deposited, FTX didn't have it. It was in Alameda's trading book. It gets worse. FTX had created its own token called FTT. Think of it like a loyalty point system, except it was traded on crypto markets and had a real dollar value. Alameda Research held a huge amount of FTT as collateral on its balance sheet, meaning FTX had loaned customer money to Alameda, and Alameda was using tokens that FTX itself had created as the backing for those loans. This is the financial equivalent of borrowing money from a bank and then using IOUs you printed yourself as the collateral. In November 2022, Changpeng Zhao, the founder of Binance, FTX's main competitor, announced publicly that Binance was selling its FTT holdings. The price of FTT started to drop. As FTT fell, the value of Alameda's collateral fell. Customers began to panic and request withdrawals. FTX couldn't cover them. The acute crisis ran just 72 hours, from frozen withdrawals to bankruptcy filing. 1 week later, FTX filed for bankruptcy. An estimated $8 billion in customer funds was unaccounted for. Here's the scale so it lands properly. At the time of collapse, FTX customers believed they held around $11 billion in assets on the platform. Of that, an estimated $8 to $10 billion was secretly transferred to Alameda, without customer knowledge or consent, and Alameda's own balance sheet was effectively insolvent. The firm's liabilities exceeded what it could actually liquidate. The balance sheet FTX showed investors the document meant to show the company's financial health, listed FTT tokens as a primary asset. Tokens that FTX created. Tokens that had value only as long as people believed in FTX. When belief disappeared, so did the asset, and with it, so did the customer funds. Here's where I actually land after going through all of this. What SBF did was not a crypto thing. It was fraud, plain and simple. He took money that wasn't his, gambled with it, lost, and lied about it for as long as he could. You could drop that exact story into 1929, or 2001, or 2008, and it would fit right in. The blockchain was incidental. But here's what I think actually matters, and this is the part that doesn't get said enough. FTX collapsed because someone was in charge, someone made decisions, someone had the power to move billions of dollars that didn't belong to them, and they used it. That's not possible with Bitcoin. There is no one to make that call, no CEO to go rogue, no trading desk running in the background. The rules are in the code, and the code doesn't have an override switch. So weirdly, FTX made me more bullish on Bitcoin specifically, not on crypto in general, but on the part of this that operates without anyone at the top. That said, I'm not going to pretend this doesn't also make the case for some regulation. The protection that traditional finance has for your bank deposits, your brokerage account, those protections exist because things went badly without them. Crypto needs its version of that, not to kill innovation, because people's savings shouldn't disappear because an exchange decided to run a hedge fund with their money. My practical takeaway, for what it's worth, I keep my Bitcoin in a wallet I control, not on an exchange. That's not paranoia. After FTX, it's just common sense. Not all exchanges are the same, and some are genuinely well run. But if you're holding for the long term, there's no good reason to leave it somewhere you don't fully control. Not your keys, not your coins. That used to sound like a paranoid bumper sticker. Now it just sounds like basic financial hygiene. That's where I'm at on FTX. Fraud isn't new, but understanding the mechanics of how it worked here is worth your time. Next week, Coinbase. How does a legitimate crypto exchange actually make money, and how is it different from what FTX was doing? We're going to look at their actual financials, where the revenue comes from, where it goes, and why the business works even when crypto prices fall. If you want to understand the business side of crypto, not just the price, this channel is for you.